Welcome back. Big day yesterday. The S&P and the NASDAQ hitting new record highs at the close yesterday, lifted by tech stocks, particularly AI. Take a look at yesterday's close with the Dow Industrials up 96, but the NASDAQ up 330 points. That was almost 2% on Wall Street yesterday. NVIDIA led this move, hitting $3 trillion in market value. It surpassed Apple as the second most valuable public company in the world, behind Microsoft. So now it goes Microsoft, NVIDIA, and then Apple. Those stocks this morning are trading mixed. As you can see, NVIDIA up again, another 1% right now. Joining me now is Andersen Capital Management's Chief Investment Officer, Peter Andersen. Peter, great to see you. Thanks very much for being here. What's your reaction on all this momentum, particularly in AI, leading markets?
I think it has a lot of legs on it, Maria, and I don't think that we're going to see any pause with at least the next year. I think that AI still has a lot of runway. And, of course, NVIDIA is the poster child for that. So that's where all this enthusiasm is reflected.
And do you think this broadens out, or are you just looking at those AI chip makers? I know that there are indirect companies that are benefiting and those corporates who are putting money to work in AI. How is the broadening out looking to you?
Not that great. I do not think that it is going to broaden out because it's, you know, the classic picks and shovels versus the gold rush. And so there's going to be a lot of losers in this field. A lot of companies are promising the moon, frankly, in terms of how much AI is going to enhance their business models. And I don't think that that's accurate across the board. So we're going to see some casualties. And, of course, that is one of the main things I worry about with this rally, is if we do start to see some companies that are not benefiting from AI as much as they've been promising us.
Yeah, I mean, we saw a lot of technology companies talk about putting money to work in AI, but the larger corporate sector has not yet invested to the same extent. But there's also these hopes on interest rates ahead of that's boosting this rally. Take a look at the 10-year Treasury yield this morning. We've got a new Reuters poll which finds economists predict the Federal Reserve will cut interest rates twice this year, starting in September. Futures market pricing in a nearly 71% chance for a September rate cut and a nearly 82% chance for a November cut. Mark Tepper, jump in here. What's more important here, these expectations for lower rates or the euphoria around AI?
Well, it's interesting. I'd love to get Peter's take on this, but I'm showing 1.9 expected cuts this year. And Peter, you know, if you think about investors, obviously they're very, very geeked up about, you know, AI, the AI hype, the NVIDIA hype, but they're also, the market has been rallying on the potential for these rate cuts. But when you go back through history, as soon as the Fed starts cutting rates in the 12 months after that first cut, stocks are down 23% on average. So I'm wondering, and I'd love to get your take on this, are investors at risk of getting caught flat-footed?
Well, first off, I am not in the camp of any rate cuts. I do not think that's going to happen. In fact, I think currently we're at the equilibrium rate. I think the current rates are just fine. And, you know, what proves that out so far is that look at how the markets have done with this specter of what everybody's been calling higher for longer, which I rephrase as normal for longer. So, number one, I will take that free ride, though, if ever other investors are saying this is going to be great that we're going to have, as you said, 1.9 cuts, which, you know, shows the accuracy that some people actually think they can predict this stuff, right? I'll take that ride, but I do not invest with the assumption that the Fed is going to do anything this year with a rate cut.
Okay. What about the European Central Bank? We're expecting the ECB to cut rates today for the first time since 2019. We'll get that number if, in fact, we get a cut at 8:15 a.m. Eastern, 2 hours away. Want to look at the euro this morning, as many people expect the European Central Bank to cut rates before the Fed. Are you in that camp?
Well, you know, if you look at your neighbor and they have just fertilized their lawn and you're saying, boy, my lawn doesn't look that great, maybe I should do that also. I think there will be some of that psychology happening. We should actually think independently of the ECB. It's great to hear what they're doing or what Canada is doing. But in terms of our economy, Maria, I really don't think we need to do that. And let's also face the fact that it hasn't even been a year since the Fed did its last rate hike. So if I'm in that Fed room, I'm thinking they're saying, hey, this looks potentially like we should consider some rate cuts, but let's give it a little bit more time. Let's not undo all the good work we've done so quickly.
Do you care, though, if the ECB cuts rates today? I mean, wouldn't that trigger a rally in and of itself? Here?
Well, let me put it to you this way. Do you think the board of NVIDIA or the C-suite are thinking to themselves, gee, what's going to happen over there with interest rate movements? Do we have to revise our business strategy? And I think the resounding answer is no. So there are plenty of companies out there that I invest in that I think are going to thrive regardless of the direction of interest rates.
All right,
and that's how I answer that question.
And you don't want to buy Europe right now?
I do not. In fact, I'm a U.S. investor all the way. It's been rare that I've invested in Europe. I find that that's even more difficult to understand because you need boots on the ground over there. And it's hard enough to try to figure out what the heck is going on here in the United States.
All right, Peter, great to have you this morning. Thanks very much. Peter Andersen joining us on Market.